Greetings, everyone. In the previous session, we discussed about the cost to the previous owner, a very comprehensive detail in that. Now we come to the next, move on to the next topic, that is cost of improvement, which is as per section 55, subsection 1, para B. Uh, Here, when we under this provision of the Income Tax Act, actually the capital gains are computed after deducting not only the cost of acquisition but also the cost of improvement. We have already discussed this in previous examples, practical questions, as well as theory. The concept of cost of improvement is very important and it cannot be ignored. It has to be taken into calculation because many assets, they increase in their value over the time, but because of this addition, because a cost of improvement means the value addition done to that property or asset with the passage of time. It may be addition, it may be alteration, it may be renovation, it may be improvements which are made by the owner. So section 55 subsection 1 para B, it defines the cost of improvement in detail as all the capital expenditure incurred. It includes all the capital expenditure that is incurred in making any additional or alterations to the capital assets, maybe by the SSC or maybe it was done by the previous owner. So thus, if the money is spent to improve the quality or maybe to enhance the capacity or to enhance the utility or maybe add on the value of the capital assets, such expenditure is generally allowed as deduction while computing the capital gains. However, the law very specifically provides that any expenditure which is incurred before 1st April 2001, that is the base year, before that base year, shall not be considered as cost of improvement. This is because, as I said, 2001-2 is treated as a base year for capital gain purpose. That is the reason. So we do not take into, please remember this, we do not take into consideration the any improvement done before 2001. So there are rules which are very specifically given by the Income Tax Act in different situations, that how we determine the cost of improvement. That is, first is, suppose it is in relation to goodwill. So if we talk about the goodwill or business rights or manufacturing rights or professional rights, the cost of improvements are always taken as nil. Uh, they are always taken as nil, whether it is goodwill of a business or profession or rights to manufacture or produce or process any article or thing, right to carry on any business or profession. The cost of improvement is always taken up as nil. Remember this. And the reason is that such assets are generally self-generated and they are also intangible in nature. And the law does not recognize any improvement cost in relation to them. For example, suppose a business develops a reputation over years, or it expands its customer base because of that reputation at the same time, or maybe it has improved its goodwill and therefore its customer base has multiplied. Therefore, this goodwill or any improvement done internally in order to generate it, that value will not be treated as cost of improvement for the capital gain computation. Though because of due to the expanded customer base, a company is going to earn better, but still this improvement in its goodwill will not be taken as cost of improvement, and therefore while computing the capital gain or transfer of goodwill or similar rights, no deduction for improvement is allowed. Second thing that has to be taken up, it is capital assets which are acquired before 1st April 2001. So as already said, before the base year, no COI will be taken up or maybe taken into consideration. Already it will be, I think where the capital asset they have become the property of the SSC or previous owner before 1st April 2001. Only capital expenditure that are incurred on or after 1st April 2001 will be treated as cost of improvement, and prior to that we are not going to consider that. Then another situation is when the assets are acquired before 1st April 2001 through modes which are covered under section 49 subsection 1. I hope you remember section 49 subsection 1 includes gifts, inheritance, succession or a partition. So sometimes the SSC acquires an old assets through these things, or maybe partition, amalgamation, or we have discussed just now in the previous session in detail, or what all modes are covered. In such cases, the cost of improvement will always include the capital expenditure that has been incurred only after, on or after 1st April 2001. Either it is by the SSC or by the previous owner. Whoever incurs those expenditure, they are to be taken into consideration only when we follow these dates of that is beyond base year, on or after 2001, April 2001. And this provision actually ensures the continuity or improvement of improvement cost across the exempt transfer. For example, suppose father inherited a property and incurred renovation expenses in 2003, and the son later inherits the same property. Then the son can also claim deduction for the renovation expenses incurred by the father after 1st April 2001. So this way, we can say that the inherited or maybe section, to sum it all together, that is section 49 subsection 1 defines it this way. Then let us talk about the capital asset that have been acquired on or after 1st April 2001, where these assets have become the property of the SSC or the previous owner on or after 1st April. In that case, all capital expenditures that have been incurred by the SSC or the previous owner for improving the asset shall be considered as cost of improvement. It will be considered, okay. So since the asset itself belongs to the post base year period, there is no restriction regarding pre 2001 expenditure. For example, suppose property purchased in 2010 is purchased in 2010, additional floor was constructed in 2015, then the construction cost will be allowed as the cost of improvement because it is after the defined date. Another situation can be assets acquired on or after 1st April 2001 through section 49 subsection 1 mode, where obviously anything has been acquired on or after 1st April 2001, maybe through gift, inheritance, succession, amalgamation, anything, maybe from the SSC or the previous owner. Thus, improvement expenses here incurred made before transfer of the previous owner to the present owner are also considered. For example, suppose mother purchased a property in 2005 and renovated in 12, and daughter inherited this property in 20. Then the daughter can claim the renovation expenditure incurred by the mother as your cost of improvement, because that added to the valuation of the to this to the property. Okay. So coming to understand a bit about important features of cost of improvement, because we are talking about the cost of improvement here. So we have to be very clear about this, that we cannot include any amount spent for improvement can be done. No, it includes, please remember, only and only capital expenditure. Okay, and revenue expenses, for example, maintenance, repairs, painting, you are going for a whitewash, and maybe a door was cracked, and so you just got it repaired, or there are some routine services in the house, they will not be considered under the head cost of improvement. So, you have to be clear that it has to be only and only capital expenditure. The improvement in the house should be of capital nature. Another important point is that it includes expenditure by the previous owners. This is specifically in reference to section 49(1) cases where improvement should be made by the previous owner. They will also be taken into consideration. Okay. And what about the pre 2001 expenditure? They are completely ignored. I hope this is clear to you that cost of improvement under section 55(1) para 1 subsection 1 para B represent the capital expenditure incurred for enhancing or improving a capital asset. So, the Income Tax Act allows deduction of such expenditure while computing the capital gain in order to ensure that tax is levied only on the real increase in value of the asset. The law also, we can see, also recognizes the improvements made by the previous owners in inherited or transferred asset, while excluding all expenditure incurred before 1st April 2001. So, proper understanding of cost of improvement is essential, very essential for accurate capital gain computation and effective tax planning. After understanding the cost of improvement and the details and how specifically we are going to take these things into consideration, let us move on to the computation of capital gain in case of depreciable asset. So, depreciable asset, as we have already done a question in the previous session, that is, we always take it at a written down value, and written down value, whenever taken into consideration, there will always be short term capital gain, even if that asset was a capital in nature, or maybe it is sold after 20 years. So, section 50 of the Income Tax Act 1961, it provides a special method for computing the capital gain when the transferred asset is a depreciable asset, forming part of a block of assets on which depreciation has been claimed under section 32. So, normally capital gain, we have seen that they are defined as short term and long term capital gain, but here it says that because these two terms are defined on the basis of for the number of years they have been held. However, section 50 creates a legal, you know, legal provisions for the depreciable assets. Specifically, it says that even if the depreciable asset has been held for more than 24 months or maybe 36 months, depending upon the nature of the asset, the gain arising from the transfer of such asset will be deemed to be a short-term capital gain. And this special treatment exists because the assessee has already enjoyed the depreciation deductions over the years, and therefore the law does not permit the taxpayer to claim any additional benefits generally available for the long-term capital assets. And to understand what are depreciable assets, a depreciable assets maybe is allowed under section 32, and it may include plant and machinery, furniture, factory, vehicle, equipment, computer, etc. Under the Income Tax Act, and such assets are grouped into block of asset based on the nature of assets and rate of depreciation. Therefore, the capital gain under section 50 are computed block wise and not asset wise, because actually what is the difference between block and asset? Assets are the individual or the maybe a single asset, whereas a block is the assets put in collection. Maybe suppose furnitures, all kind of furnitures are put together as one block. So this way, the section 50, they are taking up the means asset under as a block. So block of asset means a group of assets, maybe falling in the same class or category, or eligible for the same rate of depreciation, or same rate of depreciation, or eligible for the same, for example, computers are 40% depreciation block, furniture fall under the 10% depreciation block, plant and machinery 15%. So all assets in one block, they will be treated together for depreciation and capital gain purpose. Why this 50 section 50 exists? Why was there a need to that question often comes to my mind. Why was there at all a need to make or formulate a separate section altogether? The objective of section 50 is to prevent double taxation benefit. Since the SSE has already reduced taxable income over the years by claiming the depreciation, the written down value of the asset becomes substantially lower than its original cost. So, if the long-term capital gain benefits and indexation were also allowed, the taxpayer would receive the excessive deduction. Therefore, Section 50 denies the LTCG treatment and treats the gain always as short-term capital gain. What computation mechanism operates here? It is actually under this section 50, the computation mechanism is that the sale consideration of the assets transferred from the block with the written down value of the block plus addition if it is made during the year. If any, as we did in one of the question just now, means in the previous session. So here, and there are two situations that must be understood very clearly under section 50. Situation 1 is when the entire block ceases to exist. That is when all the assets in the block are sold, they are discarded or demolished or destroyed, and sale consideration exceeds the written down value, that is our WDV plus additions. Then the excess amount is treated as short term capital gain. So the formula goes something like this. I would put it here. The formula goes something like this. STCG is equal to sales consideration that is maybe we can say FVC minus opening written down value plus the COA. Okay, so suppose if the machinery has a written down value of rupees, suppose 8 lakh, any machine, 8 lakh, and this new machinery is purchased within that year, is new machinery is purchased within that year, suppose it is for rupees 2 lakh. Okay, so total block value is block value becomes 10 lakh, isn't it? 10 lakhs. Now suppose if it was entirely, it was sold for if it is sold for suppose 13 lakhs. So it is the 3 lakh that is the benefit from here, because cost is 10 lakh and so selling price is 13 lakh. It is the short term capital gain. This is how we compute the short-term capital gain. Okay, so this was the first part, or maybe first situation. Coming to the next one, the second one, that is when the entire block ceases but sales value is less. Entire block ceases but the sale value is less than written down value. That is, if all the assets are sold, sales consideration is less than written down value plus any additions, then there is no capital gain. Obviously, I would say that if the situation, as we understood in this example, if the situation is vice versa, that is, written down value would have been if less than less than the FVC, obviously there would be the loss. FVC was yes, okay. FVC was less than, or selling price was less than, then there will be a loss. So there are situations where there are also situations when then where the block continues to exist. Suppose some assets are sold but block still contains other assets, or no capital gain is computed. In this situation, no capital gain for that block of asset is computed immediately. Sale proceeds are simply reduced from the block value and depreciation continues on the remaining written down value. Okay. So, these are some of the situations which you must be clearly aware of. So, let us conclude that section 50 provides a very special mechanism for the computation of capital gain on depreciable assets forming part of a block of assets. So, such depreciation benefits have already been claimed on such assets, and the law deems any gain arising from their transfers as short-term capital gain, irrespective of the actual period of holding. The provision ensures fair taxation, prevents double benefits, and also it simplifies the computation through the block asset system under Income Tax Act 1961. So, I hope this is clear. Now, to further understand things, we will move on to one practical question, which is here before us. Now, I'll just first read the question. It says, Mr. Z sold the following assets during the year 2024-25. It says land purchase in 2001 for rupees 1,40,000, sold for rupees 3 lakhs on 15th April 2024. So that means 24 years, the land was kept for 24 years, long term capital gain. The second is machinery purchase for rupees 12,000 in 2013, sold for rupees 21,000, written down value is 6,000 on 15th April 2024. Then office furniture purchased in April 2023 for rupees 1200 was sold for 1700 on 15th April 2024. Then fourth point, shop purchased in 2004-5 for rupees 1,13,000, sold for rupees 1,80,000 on 15th April 2024. It seems he is closing down everything on 15th April. So then residential house purchased in 2004 for rupees 2,26,000 is sold on 15th April 2024 for rupees 10,60,000. He purchased another residential house for on 15th March 2025 for rupees 4,20,000. We have to compute his taxable income under the head capital gain. And the cost inflation index for 2001-2 is 100, 45 is 113, and 24-25 is 363. Okay. Let us start doing this question after putting the data together. Okay. So, we will start with the long term as well as the short term. So, because in this question we have to compute the capital gain. First, let us calculate short term capital gain. Okay, when we talk about here, I think let us first put things on the question mark, the question where it is long term or short term. I'll just put L against the long term and S against the short term. Land purchase in 2001 and sold in 2024, so this is long term. Then machinery purchased in 2013 and sold in 2024. That is again, it is, I think, is it a short term or a long term? It will be a short term because of the written down value is given. It is a depreciable asset. So this will be taken under the category of short term. Office furniture purchased in 2003 for 1200 and sold for 1700 in 2024. So this also will come under the short term. Okay, short term. Then we have the shop purchased in 24 and sold in 2004-5 and it is sold in 24. So I think this shop is the long term. Then residential house purchased in 4-5, it is sold in 24. So again, this is long term. And he purchased another residential house, that is a reinvestment or repurchase. Okay. And one thing more regarding the last point, that is he purchased another residential house for rupees 4,20,000, computes taxable income. So if anybody, though we will be studying this in detail in the next sessions, but if anybody invest the money in the capital assets itself, then they get certain exemptions, okay, from the on the taxable income if that amount is reinvested. Okay, so now point wise we are clear about that what are short term gains and what are long term gains. Let us quickly put them together. So short term capital gain, the first is our machine. Machine, the written down value is rupees 21,000. No, sorry, written down value is rupees 6,000 and it is sold for 21,000. So FVC is, sorry, machine FVC, we will just put it here, or maybe I can put it here in the bracket, that is 21,000 minus 6,000 written down value. So it is the profit or the short term capital gain is rupees 15,000. Okay. Second is our furniture. Furniture is rupees 1,700, and we assume here that if, because it is our furniture which is purchased for rupees 1,200 was sold for rupees 1,700. So your selling price is 1,700, the cost price is 1,200, but furniture is also, it is office furniture. So it is not a means it is an asset of the, it's not a personal asset, it is an office asset, business asset, and it is a depreciable asset also. And for the block of furniture, as I showed you on the previous slide, it is 10%. So we will assume it to be minus, it will be 1,200 minus depreciation, 10% is 20, which is 120, and therefore the difference 1,200 minus 120, 1080. Okay, so 1,700 minus 1080, and the difference is 620. So these are two short term, because I can see there is no other point reflecting the short term capital gain. So it is 15,620. The capital gain, it is a capital gain 15,620 rupees. Okay. After that, we come down to long-term capital gain. And when we are talking about the long-term capital gain, first we will talk about land, the first asset. So obviously, your FVC was 3 lakh, isn't it? The land was sold for rupees 3 lakhs, so it is there. But obviously, it is a long-term capital gain, so 1,40,000 will be indexed. It will be 1,40,000 into 363 divided by 100. So 3 lakh, this amount when we calculate, it comes down to 5 lakh 8,200. So we can see that cost of acquisition is much more than for what it was sold for. So there is a loss of rupees. So when there is a loss, we put it in bracket minus 2 lakh 8,200. Okay. Similarly, we go for the second set, that is shop, the fourth item here. So this is sold for FVC is 1,80,000, whereas the cost is 1,13,000. So here shop FVC is 1,80,000. Okay, and when we index the COA, ICOA, I should be writing ICOA, it is equal to 1,13,000 into, and the CII for 4/5 is 113. So this amount once calculated, it comes to 3,63,000. Okay, so again we can see a loss because COA is much more, 3,63,000. It is sold for 1,80,000. So again there is a loss. So loss again will be put in a negative figure. It is 1,83,000. Is there any other asset? Yes, residential house, the third one. Residential house. Now here residential house is sold for FVC is how much? 10,60,000. 10,60,000. Okay, FVC is 10,60,000, and then we have the indexed COA, which is equal to the cost of the house was 2,26,000. 2,26,000 into 363, and the COA, sorry, CII for 24, 25, 2000, yes, 4/5 is rupees 113, which amounts to rupees 7,26,000. Now, this is the only capital gain that we have in positive figure because two other properties are bearing loss. Now, another point also says that he reinvested in some property. So, this capital gain, so that means this from this capital gain he has utilized this amount. So, that means residential house purchased and it is purchased for 4,20,000. Okay, so the remaining gain is our positive figure. I put it here so that we can sort it out. It is 3,34,000. Now, whenever there is a long-term capital gain and long-term capital loss under the same SSE, we can use that amount to write it off. Okay, write off the losses of the other asset. See, long-term capital loss can be written off against from the long-term capital gain. That means long-term capital gain can be used to write off the long-term capital loss, but at the same time it can also be used to write off the long-term capital loss. Okay, and it is but at the same time the short-term capital gain cannot be used to write off the long-term capital loss. It can be used only and only to write off the short-term capital loss. Okay, I hope I am clear now. So this 3,34,000 can be utilized to write off the figures which are there, that is 2,08,200 and this so if we just sum them up, if we just put them together, 2,08,200 and 1,83,000, these two losses together make 8, 9, 10, 11, 1 is a 9, 3,91,000. So the loss is greater than what the gain is. So 3,91,200. So 3,34,000, the gain can be utilized to write off 3,91,200. But obviously the loss will remain standing. The complete loss is not being written off. 60,000 or 55,000 something will remain standing. No issues. But the taxable capital gain here will be only and only short term, because short term capital gain cannot be utilized to write off the long term capital loss, and therefore the taxable STCG is rupees 15,620. Okay, so I hope this is clear to you, and that is all for today. Thank you.